Check, please.
Welcome back to Everything Money. In this video, we're going to do a blind stock analysis. Multiple times we've told you that at some point you need to look at the financials and the numbers. We use our 8-pillar system to screen stocks, and we'll show you how we do this without caring about what the stock price is, what they actually do, what their name is, what other YouTube gurus are telling you they're going to do in the future. We'll show you the numbers behind a company as if you're buying the company down the street from you. What do they make? What kind of debt are they in? And can they survive a recession? We'll do all this more. We're going to try and trick Paul on this one. Paul's going to walk through the numbers without knowing any of this and give you a businessman's thoughts on whether he should be buying this or not. So I'll bring him in. Here you go, Paul. What do you think?
Oh, yep. All right. So cool. Guys, I like these blind stock analysis because it really accentuates the point of when I first start looking at a stock and use the 8 pillars, it's irrelevant what the company does right now. I'm just trying to get what falls into my wheelhouse, what falls in the numbers. Like I can talk about the best company in the world. If it's overpriced, I don't care. I don't care about it. If it's selling for, let's say this would never happen. Let's say there was a car company that everybody thought was a software business that sold for 300 times profit. That would never ever happen in any rational world. I would never even care. I don't care if that car gave me a hand job every single time I got into it. I would not buy the company.
Well, we're close to that because there's YouTube people that they want to be that specialist, Paul. So they say the first thing you should do is let's listen to those conference calls from these companies.
You. That's stupid. I didn't want to hear it.
We got to read the 84-page 10K because
they're stupid. And by the way, they're not reading a 10K. F them. They're all dumb, and they can waste all their time convincing themselves to buy a stock that shouldn't be bought.
Show us how
this is an awesome iPhone. Go learn about the iPhone in and out, and then I'm going to ruin your day in 2 seconds. It's 25 grand. Oh, F that. Did I need to tell you anything besides it's 25 grand? I don't care what this iPhone does for you. It's not 25 grand.
That's true.
So I'm trying to sell you for 25 grand. I just saved myself a lot of time by not figuring out, oh, but look, it sees my face. I can put a nice wallpaper on there. It's going to, no, it doesn't matter. It's 25 grand.
That's
Stop.
Right. So show us on this company how quickly you can determine what you're thinking on this company.
All right, $200 billion market cap, 45-year PE. That sucks. Terrible profit margin.
I love it.
Terrible profit margin. Dividend, $3.4 billion. They averaged $3.8 billion in the last 5 years in cash flow. So they're pretty much eating up all their cash flow. I hate it. I'm done.
Just like that.
Just like that. I'm done. I don't care. I'm out.
You're kidding.
No, I'm out.
What numbers do you have to see on the same document that says I'm in?
A lot better numbers. The 5-year PE is 40. The 1-year PE is 31. The 1-year free cash flow multiple is 24. What else do I need to see? Let me see the income statement. Show me the income statement.
Okay, Paul, here's the income statement. Go for it.
All right. Income's growing. Revenue's growing nicely. Net income is
doubled in the past decade from 3.2 to 6.4 billion.
Okay, but it's still a huge number. All right, next.
Okay.
Shares outstanding.
Shares outstanding is pillar number 5.
Basically the same. Okay, go ahead. Okay. Not bad.
Okay.
Total current assets, 22.8. Okay, next.
Total liabilities.
Total current liabilities. Okay, that's good. Total liability, 53. Oh, my Lord, that's a lot of debt.
Compared to?
I need to see the cash flow statement here.
Okay.
I need to see the cash flow statement. Was there 1 year that was just bad?
Let's give the man the cash flow statement.
Okay. Oh, my God. See, look at this. I don't like this.
Say it to me now.
This is so inconsistent.
So 692 million in cash flow 5 years ago, then 470.
No, but look before then. Look before then.
Oh, I see. 4.7 bill, 5,
4.5, 3.8, 700 million, 478, 2.85, 7, and 8. The average is 3.83. But it means they either make a lot of cash flow or don't. All right.
Too inconsistent for you?
I mean, this one, actually, I will say this. I will save face here. I do need to know the company and the industry. And you know why? If this is because, but their revenue is up. I'm trying to wonder if this is like a temporary COVID issue. But is there it's a chip company?
It's not a chip company.
Yeah, that margin was garbage. It was 6.8% with 20. This is the auto business. This is the auto business.
It's not an auto business.
Are you kidding?
No.
Oh my God. Okay. Go somewhere else. Go to the next screen.
All right.
Let's see the 8 pillars.
8 pillars.
Okay.
Okay.
Revenue growth is up.
So PE is high. The price to free cash flow is high, which means it's currently overvalued. You mentioned the debt, which is
Well, it means
high.
it's potentially overvalued right now.
Potentially.
I mean, the revenue growth was pretty good, but I don't know. It just... 5-year return on invested capital is not bad.
This sector,
the debt's very high.
The sector has a lot of competition, and the competition is growing exponentially in terms of the number of companies that can do what this company does.
Let's go back to the balance sheet on the liabilities side.
Okay.
The long-term liabilities is 38, so it's still 10 to 1. I was going to sit there and say, I'm like, it's not 53 billion. 53 billion is total liabilities. It's for 38. It's still a lot. 10 to 1. Jeez, oh, Pete.
Mm-hmm.
Man, that's a low margin for so much debt. That's the problem. Go back down. So as a business owner, get rid of that screen. As a business owner, I have this margin, but an insane amount of debt. And my gross margin isn't huge. It's like every dollar I add to it, so any sort of increase in interest is going to scare me. If they miss any covenants, I mean, this is way too inconsistent. And they pay out all this dividend. $3.4 billion in dividends on, last year they could afford it. Go back to the statement of where it showed the number of shares outstanding, the bottom of the income statement. All right, so and the other thing is the dividend's very consistently growing, which people would say is a good thing, but it means all this time they were paying dividends out that I don't think they could afford sometimes. To me, this isn't an obvious yes, so it's a no.
Explain it.
This is just... I don't know where to go with this. Like, okay, maybe. I don't know. I mean, the revenue growth is really high. The margin's low. The gross margin, guys, is for every dollar they sell extra, how much goes to profit? 20 cents? That's not a ton. And the bottom line margin of 6.8%? Man, they grew.
So if it's not an obvious yes, it's a no.
Yeah.
What about if they're expanding into new stores and McDonald's
that costs money? Well, by the way, if they're expanding, why the hell are they paying a dividend? That's so big. McDonald's, you said?
Just for an example.
Is this Chipotle?
No, it's none of those. It's none. I'm just saying, like, our viewers are watching YouTube channels where all they actually. Sorry, I don't want to go to extreme here, but they talk a lot about the future that's going to come, of what stores this is going to be in, and what they're going to make and what they're going to do. You like to look at more of the past, but a lot of people say the stock market is forward-looking, Paul, but you're really using the past to project your forward-looking thoughts about a company.
That's a good way of putting it. I look at the past to provide guidance for the future.
Mm-hmm.
And this past is very up and down, inconsistent. Earnings per share, I mean, look at this. It's all over the board here. Oh, from continuing operations. Normalized, okay, so, I don't know.
So why haven't you been concerned about what price the stock is?
We already looked at the price. It's called the market cap.
That's right.
That's the price that matters to me.
Should we run Stock Analyzer on this?
Sure. It might be good. No, it won't be good.
You can tell already?
Well, I mean, I didn't see any growth numbers that make me go, that justify this.
So regardless of their future potential.
Because they doubled their revenue. They doubled their revenue in the last 10 years. That's 7% a year.
Okay. Regardless of future potential, you don't need to see much more.
Let's do Stock Analyzer tool.
Okay. Okay, folks, I'm going to show you the Stock Analyzer tool. You can have this in your hands and use it yourself. We'll walk you through what a business person thinks about a company and what numbers he would assume to put in so that we make a projection of what we should be paying. Go ahead, Paul. In terms of revenue growth, let's take a look at this company.
Okay. All right. So I said 7% over the last 10 years. It's actually 6.7.
Okay.
It's been growing faster in the last 5 years and faster than... All right, let's go 579.
Okay.
Oh, look at this profit margin.
Yuck.
I mean, it goes 6, 7.5, 9. So this is where I would be like, okay, I need to know the company now. And here's why. Is this a trend that's continuing thing for a reason? This is where I have to go, okay, if this makes sense to me and it can do well, I have to make sure this, like, is this profit margin a fluke? Is it consistent, et cetera? Is it something that would work? Okay, free cash flow margin. 5.5, 6.5, 7.5.
Okay. Free cash flow.
PE 13, 15, 17.
Okay.
Same thing with price of free cash flow.
Talk about the return.
Guys, I always do a 12.5% return because I can get 9 or 10% by doing ETF. So I might as well get paid for my effort.
We're going to hit the analyze button. And
$230 a share. Yeah, fall in half. There you go.
So this stock, you need to pay in our mid assumptions somewhere in between $120 and $140 for the stock today to get a 12.5% return every year for the next 10 years. And if you're not paying that, in our humble opinion, not really humble at all, in our braggadocious Paul opinion, you are currently overpaying for this company.
You basically get 5% return instead of 12.5.
And you won't get 12. Yeah, you'll get a very
5 to 6% return.
So let's see if we put 5 across the board here in terms of a return, we're somewhat in the wheelhouse. If you buy today and our high assumptions are true, that you will make 5% return, which would be a very subpar investment moving forward.
Better than the S&P's projected returns. All right, what's the company?
Any thoughts?
I got nothing here.
Sector.
I got nothing. I think I said airline. Is it airline? It's airline. No, it's not airline because it would have gone much lower. I wanted to say Lowe's or Home Depot, and then I said car.
They actually deliver everything from Lowe's or
UPS,
Home Depot.
FedEx.
UPS.
All right.
Now that you know, and knowing's half the battle, Paul, what do you think?
I definitely would not be paying close to this price because UPS is huge. How are they going to grow from here?
More locations, more trucks.
And by the way, this makes sense because shipping has gotten really expensive in the last year. So is this sustainable? I doubt that. Yeah, it's all the more reason I want, cut in half. And that's where knowing the industry and the company kind of makes sense, but it's not to sit there and say, it's not even in the ballpark. We have to fall by half still. Mm-hmm. And then I'm interested.
You know, you've been saying it has to fall in half for like 3 years. And even I had a hard time believing you. And now so many things have fallen in half. In fact,
many things have fallen by 70, 80%.
All the growth stocks that were just completely the best things ever have fallen. Yeah.
It'll happen. It'll fall a bit more than half. These things will happen. It's just cycles always happen. You look at history. Why would it be immune to it now suddenly? Why all of a sudden now the world's going to stop having? In your lifetime, you're going to see several fall in half of the stock market. I mean, when was your mom born?
48.
So since 48, let's go look at the S&P and see how many times the S&P has fallen by half. Probably 4 or 5 times. Mm-hmm. At least 40%, 4 or 5, 6 times. That's once every 12, 15 years. It's pretty regularly. I don't know. And we've never had valuations of this magnitude before. So I think this is going to be a bigger fall than we had a 40% drop 2 years ago because of COVID. Man. Oh, well. UPS. More power to them. I just think it's going to be hard. Shipping's up a lot lately. I mean, you look at, people getting shipments of things. It's been so difficult. That's why their revenue and profits up. I wouldn't make that unless you think it's sustainable from here on out. Those profit margin numbers are probably not going to be sustainable. I mean, look how much higher they are than the last 10 years.
If you're drawn to these numbers and you've been alone in your investing journey, and if you like the software, you're in luck because we've given it to you in our everythingmoney.com app. We have a phone app. You can have access to all these numbers, financials of all the companies all over the world. You can join everythingmoney.com or patreon.com/everythingmoney. Join our community of investors that discuss like-minded folks you can bounce questions off of. You get access to myself, to Paul, to Mo. You can watch us day trade exclusively to our viewers, and you can make better financial decisions like Paul just showed you without caring about the fluff, the outside world, what other people are saying. Just look at the numbers and they'll guide you where you need to be. So that's our take on UPS. It's a no as always, Paul, but one day when it falls,
as always,
it might be in our wheelhouse. So, and then again, your job out there is to make a few really great investments in your life as screaming buys. And if they're not screaming, then it's a no, right, Paul? I mean,
yeah.
See you next video. Final thumbs up. Join the community. You're going to love it. Thanks.